How China just triggered a global oil collapse. For the last year, the world's financial media has been obsessively focused on oil supply. They're watching OPEC's every move, analyzing tanker traffic from Russia, and calculating output from new wells in Guyana and Brazil. But what if I told you that the entire world was looking in the wrong direction? What if the biggest story in energy wasn't about how much oil is being pumped, but how much is no longer needed? While everyone was distracted, China unleashed its ultimate economic weapon. It wasn't a missile or a stealth fighter. It was the electric car, and its deployment has triggered a seismic shock to global oil demand, sparking a price crash that is exposing the fragile foundation of the entire petroleum economy. We have the data that shows how they did it, and why the age of oil may be ending far faster than anyone thought possible. To really get the scale of this disruption, you first have to understand the old world order. For over 2 decades, there was one simple truth in the global economy: China was the engine of oil demand growth. With rapid economic growth, its thirst for crude oil seemed endless. Millions of new drivers hit the roads, factories ran 24/7, and entire cities were built from scratch, all powered by an ever-increasing flow of imported oil. At the start of the century, China consumed roughly 4.7 million barrels of oil per day. By the early 2020s, that number had climbed above 15 million barrels per day, making it the world's largest crude importer. In some years, China alone accounted for more than 40% of global oil demand growth. When new refineries were built along China's eastern coast, crude exporters lead their entire shipping routes to China. Saudi Arabia, Russia, Angola, Brazil, all increasingly depended on Chinese contracts. This was not simply about transportation fuel. China's rapid urban expansion generated massive demand for diesel to run construction machinery, transport fleets, and heavy industry. Entire cities rose in less than a decade, and every phase of that construction consumed energy. Oil demand was embedded in logistics, plastics, petrochemicals, and infrastructure. Oil producers built their fiscal policies around this growth. National budgets in major exporting countries assumed steady or rising Chinese imports. Futures markets priced long-term demand accordingly. Even during global slowdowns, analysts believed China would provide a floor beneath prices. Global oil producers, from Saudi Arabia to Texas, built their entire business models around this single assumption: no matter how much oil we find, China will be there to buy it. It was the primary growth market and the most important factor in setting global oil prices. China's demand kept rising, and unstoppable. Many countries built their economic future around this single assumption. And for years, it worked. But not anymore. That basic belief has just been broken. The oil price crash of 2025 and 2026 isn't just a simple story of oversupply. Yes, global production has been strong, with supply projected to rise by 2.4 million barrels per day in 2026. But that's only half the equation. The real story is the sharp slowdown in demand growth, and China is at the center of it. The International Energy Agency, IEA, has been forced into a series of downgrades. Its February 2026 report cut for global oil demand growth from the 930,000 barrel per day to just 850,000 barrels per day. While China is still the largest single contributor to this growth, the numbers tell a deeper story. The growth isn't coming from cars and trucks anymore, it's almost entirely from petrochemicals, the raw materials for plastics and other goods. Demand for transport fuels has stopped growing and is now starting to decline. The engine that drove the oil market for the past 20 years is losing momentum. And the reason is visible on the streets of Shanghai, Shenzhen, and Beijing. The shift happened faster than almost any Western analyst predicted. In what feels like an overnight transformation, China's auto market has been conquered by the electric vehicle. While Europe and the US talk about gradual change over decades, China is moving now. The transformation has already begun. By the mid-2020s, China accounted for more than 60% of global electric vehicle sales. In 2023 alone, over 8 million electric cars were sold in China, representing more than 1/3 of all new vehicle sales domestically. In major cities, the share was even higher. Companies such as BYD, Xiaomi, Geely, Leapmotor and other domestic manufacturers produce with a large scale, China calls new energy vehicles, or NEVs, which include pure electrics and plug-in hybrids, have exploded, consistently accounting for nearly 50% of all new passenger cars sold. This isn't a niche market anymore, it's the mainstream. This has a direct and devastating impact on oil consumption. The expanding of EV in China is set to displace 540,000 barrels of gasoline demand per day in 2026 alone. The IEA forecasts that by 2030, EVs could displace over 5 million barrels of oil demand daily across the globe, with China alone accounting for half of that reduction. This sudden drop in demand is crashing into a surge of global oversupply. The result, a price war and the sea of surplus oil. Forecasts from the U.S. Energy Information Administration project Brent crude will fall from an average of $69 per barrel in 2025 to an average of $58 in 2026. In 2025, stockpiles grew by an incredible 1.3 million barrels per day. The IEA has even warned the market could face a staggering surplus of 3.7 million barrels per day in 2026, which would be an unprecedented glut. Oil producers are caught in a vice. On one side, you have non-OPEC countries like Brazil and Guyana pumping more oil. On the other, you have their single most important growth customer, China, aggressively phasing out the need for their product. It's a perfect storm for a sustained price crash, one that could threaten the economic stability of nations whose budgets are entirely dependent on high oil prices. If you're getting value from this analysis and want to stay ahead of the curve, take a second to hit the like button and subscribe. It tells the algorithm that these deep dives are important and helps us keep making them. This EV revolution is a calculated, strategic masterstroke by Beijing, aimed at solving two of its biggest long-term vulnerabilities, energy security and industrial competitiveness. For decades, China's greatest strategic weakness has been its reliance on foreign oil, most of which travels through contested maritime choke points. By electrifying its massive passenger fleet, China is systematically severing this dependency. It's trading reliance on foreign oil for dominance in an industry it controls, batteries and EV manufacturing. Even as China kills its long-term consumption demand, it is taking full advantage of the current low prices for energy security. The country has been on a massive strategic petroleum reserve, buying up record amounts of crude. The EIA notes that China's strategic buying in 2025 and 2026, at a rate of about 1 million barrels per day, is actually propping up global demand and preventing prices from falling even further. It's a brilliant judo move, using the weight of a collapsing old energy system to build a fortress for the new one. This shift marks the beginning of a new era. The 20th century was defined by the power of Petrostates, nations whose geopolitical influence was directly tied to the oil under their ground. The 21st century may belong to Electrostates, nations that control the technologies of electrification, from batteries to smart grids to the EVs themselves. The losers in this transition are obvious: any nation that failed to diversify its economy away from oil exports. For countries that bank their entire future on a vision of perpetually growing oil demand from Asia, this is a five-alarm fire. Their primary customer is actively trying to quit the habit. But here is the final, counterintuitive twist. This current crash, driven by fears of peak demand and the rise of EVs, is causing a catastrophic pullback in investment for future oil projects. Why spend billions searching for oil that the world might not need in 2035? This dramatic underinvestment is setting the stage for the next energy crisis. As the current supply glut eventually clears and older fields naturally decline, there may not be enough new production to meet the remaining demand from sectors that are harder to electrify, like aviation, shipping, and petrochemicals. This could lead to a painful price spike later this decade or in the early 2030s, as oil demand growth weakens in the world's largest importing nation. The global balance of power begins to adjust. Traditional petrostates, countries whose geopolitical influence derived from hydrocarbon exports, face new strategic calculations. Diversification plans, such as Saudi Arabia's Vision 2030. Meanwhile, countries leading in battery technology, infrastructure, and critical minerals processing emerge with greater influence. The strategic importance of lithium, nickel, and rare earth elements rises. Energy competition shifts from securing oil fields to securing supply chains for electrification. For workers in oil-dependent regions, the transition introduces uncertainty. Employment in drilling and refining may decline over time. Government revenues that fund public services become less predictable. In contrast, manufacturing centers tied to electric vehicles and renewable components expand. The reallocation of capital reshapes labor markets and industrial geography. What we're seeing is not just a temporary price slump. It is the chaotic birth of a new energy order. A world where power shifts from those who pump crude from the ground to those who command the technology of the electron. The age of the Petrostates is waning, and the era of the Electrostates has begun. Thank you for watching. See you in the next video.